My name is SHAILJA VASHISHT. I am the research scholar in LPU, India. And my study relates to risk profiling of Indian public sector banks. Uh, so basically what we have done in this research is that we have specifically selected the largest public sector banks of India because they are already in the consolidation phase and government is in the process of merging them after almost a couple of decades. So in order to understand whether these mergers will be helpful or not and what kind of banks should be merged into each other, we have done a collaborative study where we have considered these banks as one group, and in that one group we have calculated the various subgroups on the basis of their risks. So we've taken the financial variables from the financial crisis of 2008-9 in order to see that whether there has been any improvement or since the financial crisis, because as we know that Indian banks performed comparatively well as compared to rest of the world in terms of financial crisis. So, but we still suffered a lot of shock. So it is important to see that what is the progress we have made since then. So basically, what the literature has suggested so far is that ownership is very important element in determining the risk profile of any banking firm, especially when it comes to public sector bank, because we have seen that they are more interested in propagating or pushing the government reforms and the populist measures sometimes, and their focus is not on profit, which is a good thing in a socialist environment, but at the same time it can be bad for the riskiness of the bank and for the investors' returns as such. So in order to find out that, and in India, public sector banks have always been criticized for being less profitable and more risky. So in order to understand that what actually is the risk profile and which of the banks are more riskier than the others, we have performed this study. Now, the major contribution, what we have done is we have the existing studies have mainly focused on the mathematical models based on the financial ratios, that is CAMELS or Z-score models that takes in the studies individual banks and gives them a score or the rating. But no mechanism as such has been followed, which is a comparative measure that they can compare one bank with all the other sectors, all the other banks in the same ownership group, and then compare on comment on the risk comparative risk profile. For that, we have used the clustering technique, which is a very common marketing and the social behavioral sciences technique, but we have used it in the financial data. So basically what we have done is 10 largest public sector banks. We have taken on the basis of their asset size, and we have taken the data for 12 years and performed this analysis on the basis of k-means clustering. Now k-means is a special clustering which already has a predefined number of clusters and lets us divide the cases into those variables. Now, why we have chosen k-means clustering? Because we already wanted to know that how many of them are high and low risk bank. So we did not need to find out the number of clusters. We already had those classification in mind, and that's why clustering, k-means clustering was used. And in order to find out in those risk profiles, what the differentiation, which variables are more significant than the others, we have used the one-way ANOVA on the clusters itself, the results of the clusters, to find out that which of these variables contribute to the forming of those clusters over the years. So these are the variables which we have used. Some of them are, so we've taken all these variables to broadly identify all the 5 major types of risk, which the Basel Committee has defined. Basel Committee, as you know, that is the standard regulatory or non-prescribing body for international standards, and they have classified the bank risk into 5 major kinds of risk, and we have taken these variables which can broadly cover those 5 types, and these are the basic descriptions of basic abbreviations which we have used in the studies so far, and these are the variables. Some of them are profitability indicators and some of them are liquidity indicators. For example, cash what is the cash and bank balance to the total asset, and the most important ones specific to the industry are loans to deposit ratio and the NPA, which has again been the point of contention for the performance of Indian banks, because we have been witnessing a very high trend of non-performing assets. So once we've taken these variables, we have applied the cluster analysis on each of on these variables for all the banks every year to see the performance trend over 12 years and see that whether those banks have improved their performance or whether they have deteriorated or remained same. So this basically shows the risk profile that the cluster, the final end results of the cluster, that which of these banks can be clustered into which risk profile. So these are the 10 banks. As we see that the bigger banks like the SBI and the Bank of Baroda, which have been the strongest and the largest banks, and they have performed much better as compared to the smaller banks like UCO banks and Indian Overseas Bank and the Central Bank of India, which have been consistently performing high risk. So further research can be conducted on the relationship between the size of the bank and the owner by taking the ownership as a moderating variable to find out that how these two are related to the risk profile of the bank. But the preliminary results show that the bigger banks, which have the higher asset base, are performing better than the smaller banks in terms of the risk profile. And as such, we've seen that these banks have improved in their performance over the years. So, which was expected out of them, and because RBI has done a lot of taken a lot of steps in order to keep the regulations in check and keep the scams in check. And despite the regulatory change in the mergers, these banks have been performing well. Although the impact of COVID can be studied, that what exactly how much big of a shock was this to the Indian economy, because a lot of loan waivers were given by the government and a lot of defaults happened in the year 2020 and 2021. So this will be another set of small mini crisis for the banks, and the impact this study can be taken further to include that effect. So as I mentioned, we use the ANOVA to actually find out that which of the variables are more significant for determining the risk profile as such of a bank. So what we have observed is that these are the p-values of ANOVA. So what we have observed is that the profitability indicators, which are the return on assets and return on equity and the net profit, they are the most significant factors throughout the period of study. For almost all 12 years, they have been significantly important for the clustering, and they have caused the major difference between the high and the low risk cluster of banks. Another major indicator, as the literature has also suggested, that is the level of deposits in a bank, that how much deposits a bank has, that shows the major confidence which the investors have, that if the investors do not have confidence, they would not like to keep their funds in that bank. So that is another indicator which has come out as a very important, significant differentiator between the high and the low risk clusters. Contrary to what literature has suggested for the other emerging economies, the difference in risk profile does not necessarily come because of non-performing assets. Now, this is a very important discovery for Indian public sector banks, because we have always had a pressure from the government for controlling the non-performing assets. But it also means that this is not a differentiator. More or less, banks in this public sector, in the government-owned banks, they have a similar range of the non-performing assets, so they do not differentiate the risk of the bank. So it is yet to be seen whether that's a part of our forthcoming study, that what is the contribution of non-performing assets if we compare the ownership structure. For example, if we compare the public and private sector banks risk profile, then does this contribution of non-performing assets change, or is it not important for determining the risk profile within the ownership group of a bank? So major basic findings, what we have found out is that we've already told you, we have tried to fill the gap in the methodology section of the banking risk by introducing a new methodology which can compare the risk in a group instead of individualistic component. And we've tried to balance out all the 5 categories of risk. Then the findings basically suggest that the bigger banks are the better performers because of the higher asset size and the more profitability. And as far as the differentiators are concerned, they are restricted to the profitability index, profitability indicators like ROE, return on equity, return on assets, and net non-performing assets, and the loans to deposit ratio, which is again a very important phenomena variable in the literature as when it comes to banking risk, does not differentiate the risk profile of the Indian public sector banks. So these are the major findings what we have gathered from the study. That's it from my side. I'm open for questions.
Thank you, and good presentation. With respect to that you are working on NPA with respect to your the other banks and all.
Right.
So what are the other factors which are usually what are the factors or key parameters you have considered in the research?
So what we have generally, we have taken these 10 variables to determine the cluster of the banks on the basis of the risk. So these variables are indicators of the 5 major types of risk, that is the operating, credit, interest rate, market, and liquidity risk. So these are the 5 risks which the international standards define. So these, we have taken that 10 variables to see that which of these variables actually contribute the difference within the same ownership category. So what we have found out that although NPAs are high in the public sector bank, but the range is similar in all these banks. So they do not differentiate between high and the low risk banks. And when they are standardized, the variables are standardized, so they don't differentiate. Similarly, loans to deposit, that means how much loans are you giving and how much deposits are you taking. That difference is generally considered an indicator of risk. So that it doesn't again differentiate between the high and the low risk banks in the same ownership category. So these two are the major standouts from the earlier literature finding. What we are doing in the further papers is comparing the different ownership groups and seeing that do the results change or would they remain the same. And another thing which we are doing is checking the impact of COVID, that with how the risk profile of these banks change, which will give us a suitable fundamental so that the policymakers can check that if these banks can survive COVID and still remain in the low risk cluster, so they are financially fundamentally strong.
Okay, thank you, Shailja, and a good presentation. And my one suggestion is like usually in any platforms or international platform, revealing the names of the organizations, right? Like this company is not doing good or something, or this organization is not having high risk, right? So that would be if anyone or any organization sees, that would be a little bit riskier and it is not recommended. Usually many researchers will hide that company's name for that purpose. Usually they don't disclose unless and until we insist to just show it to us and tell us what is it. So I would have suggested not to use or recommend any suggestions like that with respect to your findings and the names and especially the bank's names when it is in a public and international platforms. Thank you.
Yeah, that is a great suggestion. I'll keep in mind while presenting the future research in this topic.
Thank you. Thank you. Sounds great. Well.